You pull up a home listing, 3 bedrooms, decent neighborhood, the kind of place you've been waiting to be able to afford. And right there under the price, the mortgage calculator shows you your estimated monthly payment. It's brutal. But wait, you've been hearing that rates came down. The headline said so. Relief was coming. So why does that number still feel impossible? Here's the thing. The headline wasn't wrong. Rates really did come down. But for most buyers, that improvement quietly disappeared before it ever reached their monthly budget. And understanding why is the difference between spending the next year waiting for rate relief that won't save you dial and actually knowing what you're up against. So let's walk through it. The average 30-year mortgage rate right now is 6.36%. A year ago, it was 6.81. That's a real drop. That's not nothing. And if you read the coverage, you'd be forgiven for thinking that things just got meaningfully easier. But here's what that rate drop actually does to your monthly payment on a real home. The median price of an existing single-family home right now is $422,300. Let's call it $422. That's the going rate for a typical home in America today. Not a luxury home, not a bidding war special, just the middle. So take that home, put 20% down, 30-year fixed mortgage, and run the payment at last year's rate versus this year's rate. The difference is about $100 a month. That's it. $100. On a home that costs $400,000, the rate improvement that got headlines, that got articles, that felt like news, saved you roughly $100 a month on your principal and interest payment. Now, $100 is not nothing, but let's be honest about what it is. It's a couple of grocery runs. It's not the thing that tips someone from, can't afford this, to, I can make this work. And if you've been waiting for rates to rescue you, that number tells you something important. The rescue already came, and it was $100. So why does buying still feel impossible? Because the rate was never really the problem. Here's what's actually happening. When people talk about whether they can afford a home, they usually picture the mortgage, principal and interest, the loan itself. But that's not your monthly housing payment. That's just the floor. Stack on top of that property taxes. In a lot of markets, those run several $100s a month, and unlike your mortgage rate, they're not negotiable at closing. They go where the local government sends them. Stack on homeowners insurance. Stack on PMI if you're putting less than 20% down. That's the extra premium lenders charge when your down payment doesn't reach that threshold. Stack on HOA fees if the building or community has them. And underneath all of it, the thing that makes every layer heavier is the price of the home itself. The rate is one dial, but there are 4 or 5 other dials, and none of them moved when the rate came down. The rate got a little friendlier, everything else stayed exactly where it was. Think about it this way. If rates had never moved at all, your payment would be roughly $100 higher than it is right now. But the home still costs $422. Your taxes are still whatever your county charges. And your insurance bill? That's been on its own journey entirely. Homeowners insurance costs have been running hot. The national inflation signal for that category came in at 7.2% up year over year as of April 2026. That's not every household's exact bill. It varies a lot by location, by coverage, by the home itself. But directionally, one of the biggest line items in your total monthly payment has been going the wrong way at the same time rates were going the right way. So the picture looks like this. Rates improved a little. Insurance got more expensive. Home prices stayed near record levels. And the result is a monthly payment that barely budged, even as the headline said the market was getting friendlier. This is the part that matters. The question most buyers are actually asking isn't what's the rate, it's what's the payment. And the payment depends on the whole stack, not just one piece of it. There's one more layer to this that's easy to miss. A rate drop only helps you if you can actually buy. And one of the quieter forces keeping the market tight is that millions of homeowners who locked in rates below 4% back in 2020 and 2021 have very little reason to sell. If they move, they give up their cheap mortgage and take on a new one at 6+%. Their payment could nearly double on the same size loan. So they run the numbers, and most of them decide to stay. That's not irrational. That's completely logical. But the consequence is that when fewer homes come to market, supply stays tight. And when supply stays tight, prices stay elevated. which means the buyers who need to move, the renters trying to get in for the first time, the families that have outgrown their place, are competing for a limited number of homes at still high prices. The rate drop helps them a little. The locked-in seller problem does not, and you won't see that dynamic in the rate headline because it lives somewhere else entirely, in the decision of someone who already owns a home to not list it. The result is a market where the headlines can be technically true and practically useless at the same time. Rates are down. Affordability improved, a little, on paper. And yet the monthly number on a real listing still looks like a wall. Here's the reframe that actually changes how you read every housing story from now on. Stop asking what happened to rates. Start asking what happened to the full monthly payment. Because the payment is where you actually live, not in the rate chart, not in the headline. In the number that shows up after you've put in the price, the taxes, the insurance, and whatever you're bringing to the table as a down payment. If that full number crossed the line from scary to manageable, great, you're closer than you were. But if only the rate piece moved and everything else held, you're essentially in the same place you were a year ago, just with a slightly better rate attached to a still unaffordable total cost. That's not a pessimistic reading, it's just an accurate one. And it's more useful than refreshing the Freddie Mac page and wondering if 6% feels better than 6.5%. The monthly payment is the story. The rate is just one of the inputs. And right now, most of the other inputs are working against you. So the next time you see a headline about mortgage rates falling tag, and there will be more of them, you'll know the right question to ask. Not how much did rates drop, but how much did the full payment actually change? If the answer is $100 on a $400,000 home, you now know exactly what to do with that headline. If this helped you see housing costs differently, please subscribe. I'll be covering plenty more topics just like this one, taking the headline version of money stories and showing you what's actually happening underneath.